Welcome to Todd Neef Show, where I try to learn some stuff and record those conversations and share them with everyone. And little known trick, if you tell people you're recording a podcast, you get to ask them all kinds of questions. And so here we are, in this case, talking to my friend Christopher Russo. Chris is at the Mercatus Center at George Mason, and he has a background advising the Fed in Chicago, advising the Fed in New York. He does a lot of research on monetary policy as well as, economic development of pre-industrial England, which you don't really get into today. But I did meet Chris when he was getting his master's in financial economics at the University of Chicago, which I can imagine was a pretty aggressive program. And Chris came in and did some weightlifting at South Loop Strength and Conditioning during that time. And now he's a full-fledged research kind of guy. And I wanted to get his take on some monetary policy stuff, since monetary policy is confusing, it's abstract, but it is often in the news with discussions of inflation and stimulus packages and all that kind of stuff. So figured that Chris could explain to me, like I'm five, what is actually going on with all that stuff. And so there's a lot of really interesting takeaways from this episode. Some of it may be a little bit difficult to kind of get through in an audio format, but hopefully Chris was able to explain that in a way that's useful for folks. Chris does have a website that he just started posting on, right? Just sharing his articles and his podcasts and things like that, which is Christopher-Russo, russo.github.io. He just started sending out an email from there as well. So if you are into this kind of monetary policy analysis stuff, I definitely recommend checking that out, giving Chris some email addresses there. But in the meantime, check out this conversation with Chris, dive into some monetary policy. Enjoy. All right, so Chris, there's a lot of topical information about inflation. Maybe people are reading some stuff on Twitter about cryptocurrencies. Maybe they have an opinion about stimulus bills. And this is a thing that kind of like floats around in the news and in the culture, let's say. And I think a lot of people don't really actually know what's happening. And I would consider myself to be one of them, right? I can usually read some stuff and like sort of know what's going on, but just monetary policy in general is a very opaque topic. It's very, very challenging to figure out what's happening. And even with some, helpful blog posts and Wikipedia articles or whatever, it's kind of like, yeah, this is a mess. I don't get it. And, maybe a good starting point to understand what we're actually talking about when we talk about inflation, when we talk about monetary policy, when we talk about printing money, is the Treasury and the Fed, which are in fact different organizations, which, maybe people sort of think of them interchangeably. I know I probably do. What even are they? What's going on?
First, thanks a lot for having me on. This is going to be a lot of fun. And even for people like me, professionals who do this on a daily basis, monetary policy is hard. So I'm happy to try to disentangle some of these ideas. The Fed and the Treasury, as you say, are separate institutions. Treasury is responsible for the government's fiscal policy. They don't set taxes or spending. Congress does that. But they are in charge of implementing them. So if Congress instructs a government agency to spend X, Y, and Z, Treasury is there to provide the cash to do that. If Congress instructs the IRS to collect certain taxes, Treasury is the one that actually collects those taxes, the IRS being a part of the Treasury. And of course, there's a difference often between spending and taxes. That's the deficit. And the deficit is then made up for by Treasury through issuing bonds. So in that sense, Treasury in the conversation we're going to have today largely is involved with the debt management side of things. How does the government make up the shortfall between spending and taxes? It does that by issuing debt. The Fed, on the other hand, is the nation's central bank. The nation's had central banks in the past, which didn't always end up all that well, first and second bank in the United States. But the Fed was created at the turn of the 20th century when policymakers realized that it would be good to have an institution which helps provide an elastic currency to the economy. By elastic, I roughly mean one that grows in line with the needs of the economy. So the Fed's statutory obligation, if you read the law, is to provide conditions to let credit and money grow at an even keel. And by even keel, it's not the wording in the statute, but the wording in the statute is that it's supposed to allow for maximum employment and price stability. So if prices are growing too much, if there's too much inflation, that means that monetary policy is too loose, money and credit are growing at too high a rate. Whereas if we fall into a recession, that can often be because money and credit aren't growing at a rate fast enough to keep up with the economy, or have even fallen sharply in some circumstances. So that's a division of labor between the Treasury and the Fed. They work together on some things. For example, the Treasury keeps a cash account at the Fed because the Fed is in fact a bank. So it has accounts for banks and for the Treasury and for others. And the Fed also helps the Treasury do its debt auctions. So if you read in the news that Treasury auctioned off, say, a bunch of 30-year Treasury bonds, that auctioning was done, or at least facilitated by the New York Fed.
So maybe a summary might be that the Treasury is handling a lot of the internal nuts and bolts for the government relative to what's actually happening with its money. And then the Fed is more like a bank that is then interfacing with other stuff so that money can go places. Is that a reasonable way of framing that?
Yeah, I think that's reasonable from one perspective. The Fed also, I mean, it's when I emphasize that the Fed is a fiscal agent for the Treasury, meaning that it's helping the money get to where it needs to go. That's of course not the only thing that the Fed does. The Fed, in trying to have money and credit in the aggregate grow at an even keel, also requires it to take actions that are independent from Treasury, and very often acts independently from Treasury. So if you've heard of, for example, the Fed funds rate, that's the rate at which banks can lend to each other overnight in order to have enough electronic cash called reserves on hand to meet their obligations. That Fed funds rate is targeted by the Federal Reserve. The idea being that if the short-term interest rates are lower, and the broad variety of short-term interest rates people are interested in are closely tied to this Fed funds rate, if short-term interest rates are lower, that eases financial conditions, that allows banks to extend more mortgages that are profitable, and in doing so increases the money supply. Whereas if they raise the Fed funds rate, that would conversely constrict the easiness of credit and constrict the growth of money and credit. You've also probably heard about open market operations. This is when the Fed comes out to purchase Treasury securities, mortgage-backed securities, and occasionally some other miscellaneous types of securities. That also increases the money supply by exchanging Treasury's debt that's been issued to the public with this type of electronic government liability that's held at the Fed.
Got it. And so maybe a way to think about the Fed might be related to some of the meme stock stuff that was going on that I think maybe some people had some experiences with, right? Where it's like, okay, yeah, you think you're just buying GameStop on Robinhood, but what's actually happening is your trade is being put into some large system and getting aggregated up into some pool of trades that some large financial institution that people don't know exists actually handles the transactions for. And there's all this plumbing that goes on that enables people to buy and sell stocks that most people just don't really have to interface with. So it sounds like maybe the Fed is doing kind of a lot of that plumbing for the money supply, right? It's like, okay, there's money and it needs to go from bank to bank, or we need to have bonds issued or whatever. So we're the organization that's facilitating all that stuff going where it needs to go. Is that somewhat accurate?
Sure. They're certainly facilitating it. And I would say, just to emphasize, even more than merely facilitating, they're engaging in actions that increase or decrease the total supply of money, or I should say maybe the growth rate of money, in order to achieve these macroeconomic objectives of price stability and maximum employment. So in terms of the plumbing, it's useful to think about the Fed's balance sheet. So physical currency, for example, actual green dollar bills, those are liabilities of the Federal Reserve. This is a way that anybody can use Federal Reserve liabilities to engage in transactions. I can buy a soda from you. I give you $2. You give me the soda. And this is using Fed liabilities as a way of facilitating transactions. There's other sorts of Fed liabilities that you've probably have heard of, but that aren't generally open to the public. I mentioned one already. Those are reserves. Reserves are these electronic cash balances held at the Fed by banks that pay interest. So these are reserve balances. Now, you have access to reserves, I suppose, indirectly. When you have your dollars in your bank, You don't own reserves. You own a deposit. A deposit is a liability of your bank to, at your demand, give you $1 back in exchange. Now, if you make a payment to me and I'm at a separate bank, you see your deposit dollar value go down. And in your mind, maybe you think that, there's some physical stock of dollars somewhere, and I'm moving some dollars from my pile to Chris's pile. Where in actuality, what's going on is
some guy with like a bag with a dollar sign on it, just like is walking down the street, like, all right, here you go, Chris. Here's your bag with a dollar sign in it. Yeah,
right, exactly. Whereas in reality, there is no pile of money in the bank with your name on it. In fact, your bank account, your checking account, is really just reflecting a obligation your bank owes you. And when you make a payment to me, the obligation of your bank to you goes down. The obligation of my bank to me goes up. And the banks settle that on the Fed's balance sheet using reserves. So if you're making a payment to me, then your bank sends my bank reserves. And in actuality, since all these payments are happening every day, so many times, it's actually just the net amount that gets done at the end of the day.
So it's the Federal Reserve is in fact what enables these transactions to even happen.
That's exactly right. And when you hear about in the news real-time payment systems like FedNow, this is one way of trying to extend the payment system more broadly. People, for example, have talked about having personal Fed accounts, where maybe in order to increase financial inclusion, you don't just let banks have accounts. You instead open the balance sheet up to the entirety of the public, where you and me can have accounts at the Fed or have accounts indirectly through our own banks who maybe provide the nice website design that we would actually want to use rather than a government design.
And would that make transactions faster then, right? Where it seems sort of weird that it's like, oh yeah, I'm going to send money. Oh, it takes 3 business days and there's a holiday. So it gets there 8 days later. And you're like, yo, I'm pretty sure that it's 2021. Like, what are we doing?
It's a complicated question for a few reasons. Like, yes, if everyone had accounts at the Fed, it's possible that the Fed could just clear those transactions in real time or at the end of the day. There are reasons, though, that we don't often clear things as fast as humanly possible. For example, if there's a mistake, it's useful to just be able to undo that mistake before the end of the day or before the end of, say, 2 days, rather than having to try to reverse the mistake after it's already taken place. This is why, for example, stock trading, when you buy a stock on Robinhood or wherever, it doesn't settle immediately. It settles in T+2 business days. Bonds are similar. I think U.S. sovereign bonds settle in 1 day. So there is a need, I think, economically for people to have access to faster payments than they do right now. The question, though, is that appropriately done through the private sector, or is it done through the Fed, or is it done through some combination? Checks, for example, the system we now use to be able to cash checks was originally invented by the Fed, and eventually, having now invented that, that's been devolved to the private sector. So there's an ongoing discussion about the right way for the Fed to be involved in the payment system. It's certainly involved in governing it and making sure it runs smoothly, but the day-to-day of if we want faster payment, should that be our bank or should that be the Fed is still an open question.
So another Fed just logistics question that I don't understand. Cities seem to have their own Fed, which is like a contradiction in terms in some ways, right? Where it's like, well, this is supposed to be the federal thing. Like, how come Chicago has its own? What is the deal?
That goes back to some really interesting American history. And as I was alluding to earlier, we had 2 national banks before, the first and second banks of the United States, where if you're a history buff, they didn't end all that well. Particularly this, I think was the second one with Jackson, where there's that, I think, apocryphal quote where Jackson describes the Bank of the United States as really privatizing gains and socializing losses. I think he calls them vipers, among other things. There was this
aggressive.
It's aggressive, and it reflects the skepticism that's inherent in our country's history and founding of these large financial institutions. So, I mean, even going back further to the founding of the Treasury and even in the Constitution, the assumption of the colony's war debt, which was, advocated for by Hamilton. There was this deep tension between what you might think of as the Hamiltonian faction and the Jeffersonian faction about how much the economy and the government should be financialized and how much they shouldn't be. So this was an evolving debate over the course of our country's history. I'm going to be embarrassed if I get this wrong. I'm pretty sure it's 1913. When the Fed was founded in 1913, the law I think was passed the previous year, 1912. It was a compromise of these considerations, where instead of having one large institution centrally run out of Washington, instead we'd have a system of reserve banks around the country that could meet the needs of their localities. So in the original Federal Reserve System framework, you had all of these Federal Reserve banks, Boston, New York, Richmond, so on and so forth. They would really engage in monetary policy independently. They would come to DC and they might coordinate on certain actions, as they attempted to do during the Depression. But they could pursue their own objectives if they so desired, or at least pursue their objectives through different means. It was during the Depression that the Fed got reorganized into roughly what we understand its modern framework to be, where you have the Board of Governors of the Federal Reserve System. That's a government agency in Washington, D.C., which oversees the 12 Federal Reserve banks. Again, Chicago, New York, San Francisco, so on and so forth. And that's how they coordinate action. Now, it's still a system that reflects its foundings, that for better or worse. For example, the Federal Reserve banks aren't always necessarily that geographically dispersed. There's one state with 2 Federal Reserve banks in it, so it's a system that reflects.
What state is that? That sounds like useful trivia.
It's useful trivia that I should know off the top of my head. I think it's Kansas, but I don't know off the top of my head.
Yeah, that's certainly not the state I would have expected.
It's something.
St. Louis and Kansas City. I mean, it seems like
it's St. Louis and Kansas City.
Interesting.
Yeah, the St. Louis Fed and the Kansas City Fed. And that is just an accident of congressional negotiation to actually pass the original act. As you might imagine, there was a lot of backroom dealing about where exactly these banks would be. Sure.
Okay, well, so there's these, I guess, like separate entities in these cities that are doing some sort of financial plumbing, that also have some control over money being put into the economy, which we're going to get into later. But it seems like that's something that how much bottom up coordination is there, or like bottom up decision making is there, or is it top down where it's like, all right, this is how much, these are the bonds that need to go out. Like, I guess I just don't really understand how that process works.
I think it's a great question. Let me try to explain in more detail. As I was emphasizing, the Fed is obviously responsible for monetary policy. It's responsible for a lot more, too. So they have key responsibilities in financial regulation, the payment system, as I had mentioned, and some other areas. So when we talk about bottom-up coordination versus top-down control, it's often a bit dependent on what part of the Fed's mandate we're talking about. So in monetary policy is set by the Federal Open Market Committee. And the Federal Open Market Committee is composed of the governors of the Board of Governors. Those are people who are appointed by the president and confirmed by the Senate. At max, there's I think 7 of them. And then there's the Federal Reserve Bank presidents. Again, those 12 that are dispersed across the nation, of which 5 vote at any time. The New York Fed president always gets a vote, and the remaining votes are circulated among the different Reserve Bank presidents according to a schedule, which is sort of hard to remember off the top of my head. But they circulate roughly, and you can find it online who's voting in any given year. The important thing, though, is that it's a combination of individuals across the system. Again, some appointed by the president and confirmed by the Senate, others who are maybe more representative of their part of the country, and they meet to make monetary policy. They vote on the appropriate target for the Fed funds rate. That is, again, the short-term rate that helps control the expansions or contractions in credit to hit the objectives of maximum employment and price stability, as well as other actions. For example, what the Fed should be purchasing. Purchases are now managed centrally out of the Federal Reserve Bank of New York. They have an open market trading desk that I worked on for several years, and they take the instructions of the FOMC in terms of what to purchase and how much to purchase. It used to be,
Well, so hold on. What is the Fed purchasing? Like Fritos, Pringles? Like what does the Fed need?
They do purchase some to keep us fed when we're working long hours, but principally what they're buying are treasury bonds. They're also buying mortgage-backed securities, And in rare circumstances, they buy other things that are not government guaranteed. Following the financial crisis from 2007 to 2008, in order for them to do that, they need to get permission from the Treasury Secretary. So it's quite rare that they do that, and even frankly rare before the crisis. But principally, they're buying treasuries and mortgage-backed securities. So people in the media often talk about printing money. It's again useful to think about the Fed as having a balance sheet, assets and liabilities. So when the Fed goes out to buy treasury bonds, say they're buying treasury bonds from the Bank of Chris, right? That's an exchange in which they get my bonds and I get reserves. They mark up the amount of reserves in my account. It's a number in a computer. They can just mark it up. And conversely, if they were to sell me a U.S. Treasury bond, then they would mark down the amount in my account. So when we're thinking about the Fed printing money, so to speak, really, as long as they're buying and selling obligations of the U.S. government, it's more like they're managing the composition of government liabilities as opposed to, say, printing money out of nothing. In the sense that because our bonds are so viewed so positively by the world as a risk-free investment, it's just an exchange of one liability for another, one money-like liability for another money-like liability.
Yeah, and so the Fed is essentially transferring, the government's liability between itself and like another financial institution, right? That's what's happening.
Yeah, but to be clear, there's that offsetting fact there. So on the one hand, they're taking in the U.S. Treasury bond, so that's now bringing the government's obligation for the Treasury bond back onto the government's balance sheet. But they're also increasing the level of reserves as electronic paying money. So they're really exchanging one liability for another. Now, that's not the only thing the Fed does. That's what I've described as an open market operation where they go out and they buy a U.S. Treasury security. But they also engage in loans occasionally. So, for example, one of the reasons the Fed was founded was to make loans to banks who come under liquidity stress. During the Great Depression, a lot of banks failed, not because they weren't solvent, meaning that their assets were good, but depositors were worried that there wouldn't be enough money if everyone demanded their money back. So they all ran to the bank at the same time to demand it. And given that, again, the banks don't hold big stacks of cash with your name on it, they found it difficult to actually meet those on-demand requests for dollars. So the Fed plays an important role in providing loans to banks that it oversees. Again, there's that financial regulation aspect. They're overseeing the banks to make sure that they're in sound quality. But in the event that a bank is sound, they're going to lend it money to make sure it can always meet the obligations it owes to its depositors. So it's a way in which if now they're extending a loan, that's an asset on their balance sheet that is raising the broad money supply.
Sure. Okay. So to maybe try to summarize that stuff, you're saying that, when the Fed is buying bonds from other financial institutions, it's not exactly printing money. It's just kind of like reallocating where these liabilities are. And in a way that then gives banks like a larger cash supply, quote unquote, so that they can then lend that money. Is that correct?
Yeah, I think that's right. Although I would, again, this is another misconception that is common, understandably so. It's not like the banks are taking that cash it gets from the Fed and lending it out. In the same way, they're not taking your they're not taking your deposits and lending them out. Rather, think of it as trying to determine the composition of the bank's assets. The banks want to hold some cash. They need cash in order to meet their short-term obligations, to make payments, to pay out the demands of the depositors. But they also want to make loans, and financial regulations restrict the composition of their assets insofar as they want there to be enough cash on the bank's balance sheets in order to be able to meet the obligations reliably without having to run to the Fed for more cash on an emergency basis. So when the Fed buys a treasury bond from the Bank of Chris, it doesn't necessarily mean I'm going to go out to make another loan. Rather, what determines the amount of credit I'm willing to extend, aside from the regulatory requirements I mentioned before, because treasuries can also count towards those regulatory requirements, is the level of interest rates. If I think I can make a loan to you at, say, 3%. Say it's a 30-year mortgage that's guaranteed by the government. If I can make a 30-year mortgage at 3% and my cost of funds is only, say 10 basis points, that's 0.1%, then yeah, I'm very much inclined to make that loan. And whether the cash on my balance sheet's held in terms of reserves, treasury bonds, doesn't influence that decision all that much.
Cool. And then to kind of circle back to what you were saying about loaning to banks, that's more in the case of just some sort of cash flow situation, right? Where it's like, okay, this isn't necessarily a long-term problem, but right now you need cash to sort of make this situation okay. And then the Fed is going to just back that so that there's nothing blows up just from like, okay, this 7 days where the cash isn't exactly where it should be. Is that correct?
That is correct. And the Great Depression is the great illustration of this, as Milton Friedman showed a few decades afterwards, where you had all these, as I mentioned, banks that were otherwise solvent, but they just didn't have enough money on hand in order to meet the needs immediately of their depositors. The Fed was made to step in during those circumstances to provide enough money in the economy so that there wouldn't be these sorts of limitations. They didn't do that. That led to banks failing. Banks failing led to further declines in credit and hence further declines in the money supply, almost leading into a vicious cycle that made what would have otherwise been a recession and a financial panic into the Depression.
And there's an element of just trust in general with stuff like that too, where like when something bad happens, then people's beliefs and behavior surrounding money will change very drastically in a way that compounds. Yeah.
That's right. That's right. And so expectations, the way I would frame it, but trust as well, is important for understanding, say, the Fed's current actions. Again, I can only emphasize that when the Fed is making the decisions about when and how much to purchase U.S. Treasury bonds, to put interest rates at zero or to not put them at zero, it's a matter of trying to meet their objectives. And if circumstances changed, if, say, inflation grew quite dramatically and outside of the Fed's objective for stable prices, the economy, I think, and market participants trust that the Fed would take action to achieve their objectives. So you might view the same actions very differently depending on your expectations about Fed policy. And I think we see this in the news where people, in my view, misinterpret the Fed's actions as trying to, say, monetize the government's debt, where in my view as an economist, truly trying to keep money and credit growing at an even keel despite an incredible drop in economic activity.
So we talked a bunch about the kind of nuts and bolts of what is the Fed actually doing? What is it? What is the Treasury? And I think another thing that's really interesting and important to try to understand is just the role that money plays in terms of things. I mean, you mentioned like prices, you mentioned full employment, we've thrown interest rates out there. And I think a lot of people have some conception that these things are maybe related, right? That like, okay, the money supply has something to do with how all those things come together. But it's not necessarily something that's super well understood by the average person who's like reading stuff. Nor is it totally intuitive. So I guess I'm curious, like, is there a good way to think about how these things are related?
Sure. I mean, if I had to give one idea for how to think about money in the economy, I'd probably think about Milton Friedman's equation of exchange. This is the idea that total dollar output in the economy equals total dollar spending in the economy. And this is sometimes summarized as the equation MV equals PY. Now, I know this is an audio podcast, so let me not go into the math too much. But ultimately what that means is if aggregate demand, again, that's total spending, if that declines, that either means that total real output in the economy has to decline or the price level has to decline. And we live in a world where many argue prices can't adjust very rapidly, especially suddenly, to changes in demand for money or the overall money supply. And as a consequence of that, until prices can adjust, output makes up the gap. This is the sort of demand-driven view of recessions that is sort of in the mainline basic view of macroeconomic fluctuations talked about by economists. So in the Great Depression, to use that example again, we had a substantial drop in the supply of money. People's demand for money also increased, so they stopped spending it as rapidly as they otherwise would. That both factors decrease aggregate demand. In order for aggregate supply to commensurately drop, either you need a decline in prices or you need a decline in actual economic output. Prices weren't able to fully adjust, so output made up the rest. And this is why you get a situation where in the Depression, prices fall by a third, but 1 in 4 workers are unemployed, and you had a tremendous decrease in the actual economic output of the economy. We wish we were in a world in which prices adjusted more quickly than they do. If that were the case, it would make monetary policy a lot easier.
Interesting. So the fact that prices are somewhat sticky makes monetary policy more difficult because that term tends to not move in this equation that you're talking about.
Yeah, it makes monetary policy on the one hand more difficult, although I should also say is what makes it necessary in the first place. Where if prices could flexibly adjust in sort of an idealized way, changes to the supply of money shouldn't affect anything other than prices. And if just the overall price level is changing, nothing changes in terms of anyone's actual decision making about whether to spend on certain goods or how to invest. So really, monetary policy
because it's all just relative. Like it retains its like relative relationship, so it just doesn't matter.
That's exactly right. And so when economists like me talk about the Fed trying to keep money and credit growing on an even keel, and talking about maximum employment, talking about stable prices, we're not saying that we don't want relative prices to change. And of course, they should change as is appropriate given economic conditions. We're not saying we don't want no one to ever be fired. What we mean is that we're trying to prevent a situation like the Depression when everyone gets out of work at the same time, or when all prices fall quite dramatically, and the negative effects that can have on the broader economy.
So as just like a man on the street, a lot of price volatility seems like a thing that would be potentially bad, right? People get stressed out when prices for things change quickly. Is this just because people are stupid animals who don't understand the economy, or is there like something else going on that people don't like about price volatility?
Certainly, people aren't stupid animals. I guess that's the first thing I should say. Second thing, I intuitively, I think it makes sense why people don't like volatile prices, right? If you don't know what the cost of bread is when you go into the supermarket, that's not a good feeling. Particularly when you get into inflationary environments where if you're not sure that prices maybe have doubled in a day or quadrupled in a day, that's not great. If you're thinking about financial instruments, actually, there's an interesting line of research that suggests that stock market prices aren't volatile enough to explain their higher returns compared to bonds. So it's people, maybe here's a way of summarizing it. People are understandably adverse to risk. That's a very sensible thing for us as humans to be. And when we're thinking about financial products like stocks or bonds, you might think fundamentally the reason that we're paid a return for holding them is precisely because we're holding that risk.
Yeah, that's interesting. That kind of makes sense, I think. So something else that I think is useful to talk about with this that I found very helpful is Paul Krugman's babysitter club analogy, right? Which I think gives a somewhat intuitive way of thinking about how the actual supply of currency in a system will impact people's behavior, right? And it gives some insight into what's actually happening with inflation, what's actually happening if there's not enough currency to support employment, whatever. So do you mind giving a brief explanation of that analogy?
Sure. This is a fun story that goes back, I don't know, a decade or two at least, where according to Paul Krugman, it was a co-op of staffers around the Hill who at various points in time needed babysitting services. So instead of hiring a preteen to do it for them, they would just trade off with each other, and they would keep track of who had given and who was owed babysitting time by these IOUs, which you might call script. And so they would trade around these pieces of script in order to keep track of who was owed babysitting time. And for reasons the article doesn't go into and that aren't really all that important, the amount of total script in the economy fell. Maybe there was at one point enough script to, in aggregate, have, say, 1,000 hours of babysitting, and imagine that fell by half, so that the amount of script in total only allowed for 500 hours of babysitting. As Paul explains it, not only did that decrease the total supply of script in the system, it also made people more cautious about spending it, in the sense that they, are you really going to spend an hour babysitting service on this event? Maybe you want to save it until something later comes along if the amount of script in the economy is falling. So both of those factors, the first one being the money supply, or I'm calling it money now, giving away the game, but the total supply of script fell and the velocity of scripts fell. Both those things have a depressing effect on aggregate demand. And as Paul goes on to explain, this led to a collapse in this babysitting economy, where as I mentioned before, either prices could change as a reaction to the decline in aggregate demand. Prices didn't change; they were pegged at one piece of script per 1 hour of babysitting. So in order to have aggregate supply equal aggregate demand, people, they just stopped engaging in these babysitting services. That was bad for everybody. It was like a mini recession. So this parable of the babysitting co-op is a way of explaining demand-driven recessions. The idea that if you have a sharp decline in aggregate demand, either through a sharp decline in the money supply or a sharp increase in the demand for money, and prices can't adjust, that can engineer a recession that doesn't do anyone any good.
Yeah. So in this analogy, right, we're in a situation where the best outcome for everyone is a lot of trade of babysitting services for script, right? It's like, yeah, awesome. You want people to be able to go out, and you want them, by extension, to then be babysitting each other's kids all the time. And if there's just not enough script, people get cautious about utilizing it. And so they don't go out as often. It's like, oh, yeah, like you said, we have tickets for the opera or whatever in a few weeks. I'm assuming these are opera going kinds of folks, right?
These are DC folks. So yeah, I think that makes sense.
Yeah, we have tickets for the opera in a few weeks. Like it's not worth it today to go to, I don't know, something less culturally up there. So yeah, we're just going to stay home, and that just reduces the amount of transactions occurring, which is net bad for everybody.
That's right. Or as Paul might say, everybody can't pay down their debt at the same time. And so the role of the Fed in an economy that suffers an aggregate demand shock is to provide the money the economy needs. And insofar as it does that, in a way, again, to be clear, that keeps inflation under control, right? We don't want them to provide so much money that inflation gets out of control, but nonetheless, in a way that's consistent with price stability and maximum employment, it helps even out these aggregate demand shocks that we don't want to be engineering artificial recessions or artificial boons for that matter. You could imagine the opposite case where too much money enters the system and people start engaging in babysitting services that are more optimal than maybe you might call socially appropriate. So how do you solve this problem of decline in the money supply when prices can't adjust? I think Paul would argue that this is the need for fiscal policy. This is where you get pay people to with script to babysit children who don't exist. This is the analogy of pay people to dig ditches and then fill them back in. So it's one way of expanding the money supply. There are some public choice problems with that, right? You probably don't want Congress or the DC co-op to decide based on political considerations who should be getting more money. Instead, the Fed can simply expand the money supply broadly in a way that you think doesn't, or you would hope, doesn't affect any one person beneficially compared to anybody else. Another way of fixing that problem is getting rid of the price rigidity. Instead of simply having one script equal 1 hour of babysitting, instead let the value of the script adjust in the market. So if there's a decrease in the amount of script available, that would tend to increase the amount of babysitting that script could buy. This is maybe a way of thinking about the gold standard in the Great Depression. When they finally got rid of the gold standard, tying $1 to a certain amount of gold, prices were able to adjust and things got better much quicker.
Yeah, so if we're sticking with our babysitting analogy, which I think is helpful because it's tangible, right? That people have some understanding, like, okay, what's actually going on? The like you said, the price is fixed. Like one script gives you one night of babysitting, and since that can't change, if people are trying to hang on to their scripts more, then the only thing that they can do is not go out as much and not exchange script for babysitting services. But if they were able to say, you know what, actually, this script is now worth 2 nights of babysitting, right? That's something that would then change the incentive for them, and they're less apt to hang on to it because they're getting more for that script, and that would then re-stimulate the trading of script for babysitting. Correct?
That's right. And the word for that, of course, is deflation, where your money or your script's buying more than it did before.
Yeah, for sure. And so then we also, you started to introduce the idea of the Fed, which, let's say that there was a Fed-like entity in our babysitting co-op, right? That, like you mentioned, that they would potentially want to introduce more script into this local economy so that since prices can't move, well, okay, we can at least give you guys some more of these scripts so that you're less stingy with them, right? That you're hanging on to them less. And so how would a Fed do that in this analogy, right? Would it just be like, all right, we're just going to start mailing script out to people? Like, what actually would happen?
Ben Bernanke has a funny thought experiment about the Fed trying to do this sort of thing. He's using dollars, of course, in his analogy, but that's why it's sometimes called helicopter Ben. It's the helicopter drop, where if you really need to stimulate aggregate demand in a last ditch effort, you could fill up a helicopter with a bunch of dollar bills or analogy script, and you could just dump it from the sky, and people can pick it up, and therefore you've increased the money supply. Of course, that's a fiscal policy action. So back to the division between responsibilities of Treasury and the Fed, this is not something the Fed really has the authority to do. The question then becomes, how can the Fed still stimulate increases in the money supply if they can't engage in deficit spending, which of course is of Treasury's purview. So this is why interest rates are so important. Really, the Fed is trying to change short-term interest rates in a way that gets the private sector to increase or decrease the growth rate of money. As I was explaining before, your deposits at your bank aren't actually liabilities of the Fed. It's not a liability of the government. It's a liability of your bank that we're treating like equivalent to dollars. I mean, in that way that they are money. And if your banks want to issue a mortgage, simply they're creating the deposits they use when they make that loan. So in this babysitter co-op example, you could imagine a world in which people could create their own IOUs for babysitting at some future date, and there's an interest rate on those IOUs. And say the Fed of this world is changing the interest rate that are paid for those IOUs. If it's less costly to issue an IOU for some time in the future, you'll issue the IOU in the future and engage and take the babysitting services you want today. So that's maybe a ham-fisted way of explaining how changes in interest rates in this sort of hypothetical economy could allow for private individuals to issue more script, and in issuing more script, reflate the economy to where it would otherwise need to be.
Yeah, so when we talk about interest rates, then it can get a little bit confusing because we're talking about interest rates for the, let's say, banks or whatever, borrowing from the Fed, which then can impact the interest rates that banks are charging on their own loans. Is that correct? Because that's something that's a little weird sometimes.
Yeah, there's one way of simplifying it is to think about short-term interest rates and long-term interest rates. So the short-term interest rate, for example, is what the Fed pays banks on the reserves banks hold at the Fed. That rate is closely tied to the rate that we're paid on our deposits at our banks. Usually there's a spread in between the two. Part of that is market power, right? It's hard to negotiate with the big banks about what they're going to pay you as a depositor. Another part of it is that they are providing you services, and those services eat into their profit margin. So it's in some sense it's reasonable that they give a little bit less onto you to cover the cost of those services. So that's short-term interest rates. Short-term interest rates are going to be the cost of a bank's liabilities. There are also long-term interest rates, like for example the interest rate on a 30-year mortgage. Those are generally higher than short-term interest rates, and sometimes quite substantially higher. So why might a long-term interest rate be greater than a short-term interest rate? Some of that is, again, about risk. Where suppose you buy a 30-year mortgage, suppose the bank issues a 30-year mortgage. They are worried about one, credit risk. There's a possibility you don't pay the loan back. Well, a lot of mortgages in the United States are actually guaranteed by the U.S. Treasury. So that's less of a concern for mortgages in particular. But the fact generally holds. Credit risk makes long-term loans and riskier and makes, therefore, their interest rates higher. Also is inflation, where embedded in that interest rate of, say, 3% are some expectations about future inflation, maybe 2% a year, which is what the Fed targets. If inflation, though, is much higher than 2%, unexpectedly so, then that eats into the profit margins of the bank. And so there's some premium, say, in that loan possibly to account for that additional risk. So this is when you're thinking about, say, credit issuance, it's really long-term rates minus short-term rates. The difference is a kind of spread the bank earns in making the loan. And again, they're constrained not just by that profit-seeking motivation, but also by regulations that the Fed and other oversight of agencies put on their risk-taking.
So you mentioned the target of 2% inflation. Why target 2% inflation? Seems arbitrary.
From one perspective, it makes a lot of sense, I think, right? If you think about central banks as coming onto the scene as providing a sense of discipline on the government so that inflation doesn't run out of control, the idea that, we're not going to let inflation run at, say, 5% or 10% makes a lot of sense. But what has caused people confusion more recently, I think, is the idea that the Fed wants inflation of 2% and they're not going to tolerate lower inflation. For example, they're not going to tolerate inflation at 0. And in fact, the Fed came out last August to announce a change to their policy. Not only are they going to target 2% inflation per year, they're going to look for an average of 2% inflation over time, meaning that if they fall short of that target, as they've done in the last decade, they're instead going to try to overshoot to have an average of 2% over time. So why is it the Fed wants 2% inflation on average as opposed to 0% inflation? Right? Intuitively, again, price stability might indicate that they should be going for 0%, not 2%. Well, in the Fed's judgment, they're really trading off their two objectives. They're trading off that objective of price stability with maximum employment. And in doing so, they're thinking about the following. Interest rates have fallen quite tremendously in the last several decades. Whether you're looking at long-term rates, short-term rates, they've fallen a lot in the developed world. And at least in the US and in Europe and Japan, they've fallen just about to 0. So if their usual tool for increasing the rate of money and credit growth is to lower interest rates, that puts a limit on how low interest rates could go. That's a problem for the Fed because in times like the financial crisis or in the COVID pandemic, we really want the Fed to be able to stand ready to stabilize aggregate demand. If they can't stabilize aggregate demand, then again, we've got to turn to Congress to do something on the fiscal side, and that has sort of public choice issues, or something else needs to happen, and this would not be a great thing. So in targeting 2% inflation, that raises the level of interest rates. Again, because if you expect 2% inflation, you're going to charge a higher interest rate to accommodate that. So 2% inflation is a way of getting interest rates a bit above 0, so the Fed has enough room to cut interest rates in times where it's appropriate. And this notion of average inflation targeting, where they're going to try to target an average of 2%, is one way of further bolstering the credibility of that 2% target. So that even if they fall short, they're going to average 2% over time.
Yeah, so it basically just gives a buffer, right? That we want to be able to, like you said, okay, in the case of a crisis, whatever, you can just yank that interest rate down, which is then going to be a great way to react to like a sudden drop in demand. And if you target 2% inflation, that gives you more of a buffer to be able to do that. Whereas if you're targeting 0% inflation, you have no buffer. So if something goes wrong outside of a certain bandwidth, you don't have the tools to react to it from a monetary policy perspective.
That's exactly right. And by having 2% inflation, the hope is that it's low enough and stable enough that we can still take it into account in our decision making, but that it doesn't influence our day-to-day decision making. We're not thinking about when we go to the store, inflation's X. Am I going to be able to afford bread on my salary? Rather, it's we're going to ask for a cost of living adjustment every year, and when we think about making long-term investment decisions, in the back of the mind, we'll think, okay, every year from now, dollar's worth 2% less than it is today. So those things we hope don't impact economic functioning all that much, especially compared to the alternative where the Fed can't engage in appropriate policy, and instead tons of people are put out of work.
Yeah, and to your point just about that 2% number, that is something that if someone is, doing just some like moderate investing or whatever, that they probably have some intuition for that, where it's like, okay, this is the interest rate that I get from my bank in a normal savings account. This is the interest rate that I get from my bank in like an online savings account that's higher. Maybe I have some investment in an index fund that's going to return like an 8% average or whatever. So you're sort of like aware of like inflation chipping away at cash balances, and then sort of aware of like what you can actually expect from growth of some relatively standard investment, and that like you just sort of like move stuff around based upon that in a way that you don't even have to think about it that much, which I guess is the goal. Yeah.
Yeah, that's exactly right. And insofar as you ever need to do the calculation, it's an easy approximation. If something is a return of 8% in dollar terms, let's say, and inflation is 2%, then the actual real return is 8 minus 2 equals 6%. That approximation gets a little bit wonky when you're talking about much larger numbers, but for anything any normal person has to do in their lifetime, it's just a matter of subtracting off 2% from what you expect the return to be.
Yeah. Yeah. That makes a lot of sense. That's great. I didn't know about 2%. Here we go. We got to figure it out.
Yeah. That goes back to Irving Fisher, who's an economist back early on, very influential guy, his approximation.
Yeah. Thanks, Irving. We appreciate it. So we started to talk about full employment related to interest rates a little bit in our babysitter analogy. But again, this is something that is a bit of a trade-off, right? And that folks who are talking about monetary policy or commenting on macroeconomic trends or whatever will discuss the relationship between interest rates and full employment in a way that I don't think is always super clear if you're not well versed in what's going on. So what is the actual relationship between interest rates and full employment?
First, I think we probably should define full employment. And
Yeah.
if you actually read the Fed statements, it's kind of a
contentious.
mouthful. It's contentious. Trying to explain it in a way that's accurate and such is a bit difficult to do. The Fed talks about a broad-based measure of full employment. They're not just looking at the unemployment rate. They're also looking at labor force participation and other measures of labor disutilization. So what's sometimes called youth 3, that's quote unquote the labor, that's the unemployment rate. That's a measure of how many people are looking for jobs as a percentage of the people who are currently in the labor force. I should say people who are out of jobs looking for jobs who are currently in the labor force. And again, even that I'm probably messing up a little bit of the details here. It's a pretty precise definition, but that's the gist of it. But of course, the labor force participation matters too. If people simply aren't in the labor force because they don't think their prospects are good enough to ever find a job, that's arguably not full employment. But on the other hand, we're not looking to get the unemployment rate down to 0%. We realize that some unemployment's sort of structural. It occurs because people are engaged in a dynamic economy. You might be put out of work because your sector is no longer profitable, or you might be temporarily out of work as you're looking for a job following maybe a graduation from school. So these types of considerations are what policymakers generally think about when considering full employment. So I guess then the question is, how does Fed policy, how do interest rates affect this very real quantity of how many people are unemployed in a given year? And again, it goes back to that issue of financial intermediation, whereby controlling short-term interest rates, the Fed can make financial conditions looser or tighter, and in doing so, engender greater or lesser economic activity, or a lesser and greater growth rate of economic activity. I should be clear, though, that even economists aren't entirely clear about the transmission mechanism through which that works. So, in a very simple model, how do interest rates pass through into the economy? Well, households are making decisions about how much they want to invest versus consume, and that investment might even take the form of, say, buying durable goods like refrigerators or ovens, as opposed to more non-durable spending like on food. There's a paper by Bernanke and Gertler which talks about this. It's their black box paper. The idea is basically it's really hard to know how monetary policy works. It's an open question. In my best understanding, it is about making these financial conditions either looser or tighter. And by the banks engaging in credit creation, they're stimulating the economy. You're getting credit to take out auto loans, to take out mortgages, to take out credit card loans. All these things are important for growing what you might call the broad money supply, and that is going to juice up the economy. And in times where the economy is otherwise in bad shape, that can be helpful overall. I forget what your original question was. Maybe I should go back to that and try to answer.
Yeah, I mean, it was basically just asking something to that effect of like, okay, if we do have this entity, right, the Fed that's controlling these interest rates with the goal of controlling inflation, and then also the goal of stimulating economic activity, right, it can turn this knob a little bit, which will impact, like just like you're saying, and maybe is somewhat unclear exactly how it happens, but the ability with which consumers can access credit will change their spending behavior, right? And you want that to be the right amount of ability for them to access credit so that they're engaging in a lot of economic activity without making it too much such that you're creating inflation. Is that somewhat right?
No, that's exactly right. That's exactly right. And let's have you cut that together in a way that makes me sound smart rather than.
It's great. It's great. Well, so when we were then talking about like monetary policy, interest rates, whatever, we have this inflation target. We have this idea of like wanting to give people the access to credit that enables them to engage in economic activity. It seems like the Fed, despite what people with laser eyes on Twitter may say, is actually pretty good at doing this correctly. Right, that like there seems to be a pretty robust capacity to turn whatever knobs need to be turned to get these outcomes. And is this something that the Fed is just like, yo, we know exactly how to do this? Like, what's wrong with you people? Or is it something where it's kind of like, some grandma making some sauce where, she's like taking a test and putting some herbs in and is like, oh yeah, it needs a little more tarragon or whatever. Like, I mean, what are the nuts and bolts of how this happens?
Well, I mean, I can't speak for them, but I would say it's maybe more like, grandma making some sauce, where it's learning by doing. In the last century, let's say, economists have over time learned a lot about how the economy works and learned how monetary policy interfaces with the economy. And still, though, the Fed is learning about the best way to conduct monetary policy. We saw this in the last decade, for example, coming out of the global financial crisis, where unemployment was slowly falling, but falling nonetheless. FOMC participants made forecasts for what their views about maximum employment were. So how low could inflation fall, let's say, before triggering an increase in inflation above the Fed's 2% target. And it turned out that the participants' projections were just totally wrong. They were projecting, I don't have the numbers in front of me, but think like 4%, 5%, 6% maximum for the appropriate level of unemployment, where in reality unemployment fell to about 3.5% prior to the pandemic, and was there for a while and seemingly not triggering inflationary outcomes. So again, it's a learning by doing process, and this is why the Fed in August came out with their announcement about average inflation targeting. The idea that not only did unemployment fall lower than what they projected it could have fallen, in which case they might have tightened prematurely a bit in the last tightening cycle, but also in doing so, inflation never hit 2% on a sustained basis, and needing to make sure that the market really understood and the world really understood that they're committed to hitting 2%, or else we run into the problem I mentioned before, where interest rates fall even closer to zero and they can't do the appropriate actions during a recession.
Yeah, so we're talking about also, I mean, complex systems with a lot of nonlinear dynamics, and the amount of volatility in something like this is something that I don't have a good intuition for, right? So I mean, if we take something like the stock market, which is different than the economy, which is also a tricky thing that we haven't really talked about, right? But the idea that like, oh, you can just like follow this idea and like kind of do these things and guarantee this outcome just by sort of tweaking stuff, right? That doesn't seem to hold necessarily in an environment like that, because there's so much volatility that depending on what kind of financial instruments you're using, like, you could end up like, really getting yourself in trouble thinking that that's something that you can do. Whereas it does seem like in the whatever macroeconomic policy realm, that you can kind of like react to stuff and tweak things. And even though it is a complex system with nonlinear dynamics, that it's not as volatile. Is that true?
If macroeconomic outcomes aren't very volatile right now, I think that's a testament to, on average, monetary policy doing its job. We don't want a world in which the Fed is, at least I don't want a world in which the Fed is always front and center on the cameras. I think it's an unfortunate outcome of the last decade because it's taken air out of the room when it comes to other policy proposals and other areas that I think need a lot of attention. So if the Fed can jump in to stabilize aggregate demand when necessary and otherwise take a back seat, I think that'd be a great outcome. And to the extent that it's been able to do that maybe in the last 50 or 60 years is, again, a testament to good monetary policy. But again, it's about learning over time. The Fed doesn't have a playbook from God about how to appropriately adjust interest rates. And so sometimes it's going to make mistakes in doing so. Oftentimes people argue that the Fed should not make discretionary decisions in that way and instead should follow a rule. But of course, I would emphasize that, in fact, putting a rule together is itself a kind of discretionary exercise where you're choosing what goes into the rule and you're choosing not what doesn't go into the rule. And you're choosing how much weight to put on certain parts of the rule and how much weight to put on others. So you and your audience might have heard of Taylor rules, for example. That was a mathematical formula that attempted to describe how the Fed made policy decisions. But Taylor rules, if you were to apply them today, and by that I mean a broad set that you could feasibly come up with, many of them suggest that we should have interest rates much higher than they are today, at say 4, 5, or 6%. I would argue that coming out of a pandemic when the economy is still quite weak and in need of support, having a 4, 5, or 6% Fed funds rate would be disastrous for the economy, precisely because it would slow money and credit growth in a way that the economy simply doesn't need right now. To keep in mind what you might think of as sort of a neutral Fed funds rate, a rate at which in the long run the Fed funds rate would be appropriate to be at based on macroeconomic fundamentals like productivity growth and population growth, that's maybe around, say, 2%. So right now it's 0. Long run, you might think of it being as 2. And if you were to apply some simple rules that might have made sense 2 decades ago, you would instead get a rate that's more than 3 times that.
Got it. So if we make this a little bit topical, right? I mean, currently, this is summer 2021. Some consumer price index numbers have come out in the last, month or so, or 2 months or whatever, that are making people freak out. If you follow the discourse around it at all, some people are like, whatever, it's lumber and rental cars. Like, there were very obvious supply chain issues with those things due to the pandemic. Not a big deal. Just wait 6 months and everything's fine. And then other people are like, we told you this would happen. The government printed trillions of dollars. Everyone's screwed. I maybe have my own opinions on this, but I guess I'm curious, like, what is your take on how the Fed should react to this? What is the monetary policy implication of increased CPI numbers? Should people be worried? What's going on?
First, let me say I don't think people should be worried. This is almost like, the only thing we have to fear is fear itself moment.
Yeah.
If people come under the belief that inflation is going to run out of control, they're going to make their decisions in a way that then leads inflation to run out of control. It's, again, that notion of expectation matters quite a lot. If you want to think about a simple way of understanding today's inflation, you might think today's inflation is what you expect inflation to be over the long term, plus some factor to do with pressures in the economy. Those are like supply chain disruptions, like you had mentioned. If there's a recession, that tends to depress inflation as economic activity slows. But in the long run, inflation is anchored to people's expectations of inflation, and so then the question I think you're driving at is today's inflation indicative then of these expectations coming unglued? What really is it that anchors these expectations in the first place? Because if you don't have an explanation of that, then it becomes like Peter Pan. You can fly if you believe you can fly, which doesn't really help monetary policymakers all that much. So in my view, what matters more for monetary policy is not month-to-month inflation. Right, we're recovering from a pandemic. We're reopening the economy. We've got some supply chain disruptions. It makes a lot of sense that inflation's high now and has been high in recent months, and maybe high going forward for say the rest of the year. I don't know. Inflation's very hard to forecast. I don't have a forecast of it to provide for you, but say in the worst case scenario, inflation remains high over the next few months to the end of the year. The question, though, is for the Fed, does that mean that money and credit are growing at too quick a rate relative to the underlying economy? Or, as I think policymakers are generally arguing, as the economy recovers from Corona, more so as the supply chain issues resolve themselves, will inflation fall back towards the Fed's 2% target? And that's really the critical issue that I think I'm thinking about and that others are thinking about in this monetary policy world. Is monetary policy appropriate for that eventuality? In my view, it basically is. We're still recovering from the recession. Aggregate demand needs support, and it will need support until we see the labor market come back to a place of close to full employment. Now, what I suppose then the question is, what are we risking here? Suppose I'm wrong. Suppose others are wrong. That in fact that really what the recent inflation reflects is not supply chain disruptions or other transitory factors, but are instead people slowly or maybe soon going to become concerned about higher levels of inflation. What would the Fed do then? Well, I think the Fed would do what it did in the 1970s and the 1980s, namely raise interest rates to the point that the inflationary pressures get stomped out. And again, this is not to be circular, but this is where expectations really matter, because if people understand and they expect that the Fed would do that in the case that inflation got out of control, they won't expect inflation to get out of control in the first place. So a useful thing to look at is actual measures of inflation expectations, and I've got a dashboard on my website that has some of them. And generally speaking, these measures of inflation expectations, either from households or from participants in bond markets who trade securities that whose prices reflect inflation expectations, as well as those of professional forecasters, all have their long-term inflation expectations pretty closely anchored to 2%. So from that perspective, again, I'm not worrying. I don't give financial advice, but I would just sort of caution the listeners not to worry. If there is going to be a risk of higher inflation, it's not because of the last few months. It's an institutional question. Is the Fed committed to getting 2% inflation over time? In my view, it is, and I hope it remains so going forwards.
Yeah, so your view is basically that the Fed has the tools to react to whatever is happening to hit the interest rates that it wants to hit, and that there is potentially some scenario in which people's behavior can become unmoored from the expectations that the Fed is going to hit 2% interest rates, which then could potentially cause some sort of compounding situation that could theoretically result in problematic inflation, but that the Fed in and of itself, assuming that extreme outlier doesn't happen, can, add some tarragon to our sauce that we're talking about and be like, no, we're getting 2%. Like, I don't know what you guys are doing.
That's exactly right, especially given that they've undershot that inflation target for the last decade. It makes sense, in my view, for them to be patient in order to make sure they're really on track to hitting 2% average inflation over time. We don't want a situation in which they pull back support too quickly, pushing us into a double-dip recession. That's a lot harder to recover from, precisely because of that zero lower bound situation I mentioned earlier, where they can't move interest rates below zero, and therefore is capped on the amount of accommodation they could have. But again, if we're thinking about what the risk is for higher inflation, this is not my expectation, this is not my forecast, but if you think about what a reasonable risk scenario could be for higher inflation going forwards, it's for political reasons or other reasons that policymakers not being as committed to their inflation objective as they should be. If they come to think that their responsibility isn't to stable prices, but is instead to, say, climate change or whatever the sort of hip political issue of the day is that is not within their maximum employment and price stability mandate, then that's the case in which all the cards are off the table.
So you mentioned that interest rates, negative interest rates are a thing, though, correct? That's a thing that people talk about.
In Europe and Japan, they are, and it's possible that the Fed could have negative interest rates here. They've discussed that issue at length in different FOMC meetings. Their conclusion, insofar as I understand it, is that they don't think that negative interest rates would be all that more helpful for the U.S. economy, and that they think that it carries certain financial instability risks. So negative interest rates, for example, can put pressure on bank profitability, and that can lead to bad outcomes in the banking sector. And of course, if you have some sort of banking crisis, that itself is bad for macroeconomic performance. So it's the Fed's view that they're going to use other tools to provide accommodation when at that zero lower bound. They could, in principle, engage in negative interest rates, but even then, there's a limit to how low rates could go. For example, in the Eurozone and in Japan, where they do have negative interest rates, there's a limit on how low they could push rates because, of course, if those got passed through to depositors, they could merely take out their deposits, earning a negative yield, and instead hold euros or yen, which are going to yield zero, actual physical currency.
Got it. So there's potential negative, weird banking outcomes that can happen if you start to play around in the negative interest rate world. So question on that. So the idea would be if someone is, if there are negative interest rates, I mean, I imagine that the way that banking works, right, that different aspects of the business have different levels of margin. And then if you go negative interest rate, that the sort of like general consumer stuff, which is probably somewhat more lower margin, it gets in trouble. Is that the idea?
I think the idea more so is that, again, these banks are holding these reserves at the central bank. Those are going to start to yield negative values, say like, just to throw a number out there, negative 1%. But on the other hand, they have these deposit liabilities that they're not inclined to pay a negative interest rate on. Consumers do not like negative interest rates, just sort of as a gut feeling, and I suppose understandably so. So then their financial difficulties come into the fact that they have these large amount of cash reserves that they have to hold that are paying, say, negative 1%, and that their liabilities that they would otherwise want to offset that with by paying negative 1%, they're instead, because of whatever reason, inclined not to pay negative 1% and instead pay zero. So that drags on bank profitability, and in dragging on bank profitability, you're weakening the banking system, and then weak banks sort of just intuitively aren't great for macroeconomic performance. Insofar as a financial crisis, for example, like we saw in 2007, 2008, can have some pretty long-lasting negative effects on growth.
Got it. So yeah, I mean, a big role of the Fed is to stabilize the banking system, and the view is that negative interest rates would destabilize the banking system, which is not what we want to happen.
I think that's right. Yes.
Yeah. Cool. Yeah. That seems reasonable to me. I support it. So Chris, I mean, we've gone through a bunch of stuff here, a bunch of somewhat abstract, difficult concepts. I mean, I personally have learned a lot. I still feel somewhat confused about the whole big picture of monetary policy, but a little bit better. Is there anything that you think is like a useful thing of like, hey, here's a good way to think about this stuff to sum it up for people if they are interested?
I think that Milton Friedman equation, MV equals PY, is, if you have one thing in your mind, that's what I would keep in mind. So let me explain that once more. And again, apologies because I'm discussing an equation verbally. But MV, that's M times V, equals PY, P times Y. M is the total money supply. That's how much money's out there in the economy. Think of that like physical currency, these reserves that the banks hold at the Fed, as well as your deposits, which are, again, a type of credit. And so money supply times velocity of money, V. Think of it as the speed at which people spend money. So M times V, that's total spending in the economy, or also called aggregate demand. Now, aggregate demand has to equal the other side of that equation, P times Y. P is the price level. It's the sort of general price of the goods and services in the economy. And Y is the real economic output. So prices times the actual goods and services in the economy, that's aggregate supply. So aggregate supply equals aggregate demand. Now, when you're thinking about a policy or some change to the economy, think through, of those four different variables, what are changing and what stays the same. So in the case of the Babysitter Club or the Great Depression, or in some cases like the 2007-2008 financial crisis, we had a precipitous decline in the money supply. So M is going down. Velocity is also going down because people don't want to spend money. They have a higher demand for cash balances in these uncertain times. So M goes down, V goes down. That means M times V also goes down. Aggregate demand falls. So in order to have the equation balanced, you have to have some action on that right-hand side, P times Y. either prices are going to move, prices are going to go down, or you're going to get real output going down, or some combination of the two. And because of sticky prices, oftentimes P doesn't fall as quickly as it needs to in order to not have an impact on Y. So when the Fed comes out and they say, we're lowering interest rates, we're doing these bond purchases, we're doing X, Y, and Z in order to stimulate aggregate demand, what they're saying is the economy can't react to these big shocks hitting the economy. The economy can't react to these big aggregate demand shocks. So we're going to stimulate aggregate demand in order to help the economy get to this new long-term point, at the point where prices can fully adjust. And so when the Fed does this, it's a way of keeping actual economic activity on track. And conversely, this is why we don't want money growing too quickly, because if money grows too quickly and you think about, say, long-run economic growth, Y is being fixed by fundamental factors, the way that gets offset to have the equation balanced is by having the price level grow. So that MV equals PY, if people are interested, I would recommend looking that up. Wikipedia, I'm sure, is a good place to start. And if you can have that equation sort of nailed down in your mind, it's a useful first step for thinking about macroeconomics and monetary policy generally.
Totally. So this may be a little bit of an aggressive tangent to go on, but I've heard some people argue that COVID's economic effects should actually be modeled as like a supply side issue rather than a demand side issue. And their argument is essentially that the demand is there, but there is not, in fact, a safe supply of the goods that are desired. And that's a better way to think about COVID's economic impacts. I don't know enough to evaluate this argument, so I guess I'm curious about your thoughts on that.
I think that is an important part of the picture, particularly early on in the COVID pandemic, where the economies were shutting down, and again, due to fundamental factors, why total output is decreasing. And traditionally, when doing monetary policy, you think about trying to see through these supply shocks in the same way the Fed's trying to see through the temporary supply shocks with the reopening and the supply chain disruptions. The Fed is trying to stabilize aggregate demand, not try to fix pandemics or supply chain disruptions it really has no control over. What I think people generally came to think at the start of the pandemic, and I think I still buy this, is that even despite part of it being driven by these supply side factors, there are also demand side factors that play an important role. So, for example, if there's a pandemic going on, you're not going to go out to eat, and you're gonna save a lot more of your money, say, and save it up for a time where hopefully the economy is reopening and you can actually engage in that spending you want to. So I think there is a demand side dimension to the pandemic and the ensuing recession, and that it's reasonable and appropriate for the Fed to try to stabilize aggregate demand given that fall.
Yeah, I think that the uncertainty aspect is a very compelling argument that there is a significant demand size component there, where it's like, yeah, even if your job wasn't affected per se, you might have been like, I don't know what's happening. I feel like my company might just decide to lay everybody off in the next 2 months. Like, I'm not spending a cent, right? And then that becomes an issue as well.
That's exactly right. And there's a part of the academic literature that tries to understand aggregate demand shocks as these sort of uncertainty shocks, where precisely as you're saying, when uncertainty rises quite tremendously, people pull back on aggregate demand, their total spending, and that can lead to almost a self-fulfilling recession.
Yeah. Amazing. So, Chris, this is a very dense conversation with a lot of information. You are at George Mason. You do a bunch of research. You've been blogging. You've been writing articles. You sent an email to your email list. If people are interested in monetary policy, if they're interested in the economic history of pre-industrial England, if they want to keep up with this stuff, what should they do?
The best thing to do is Google my name, Christopher M. Russo. That's Russo. I put my middle initial in there because there is another gentleman, also Christopher M. Russo, who's a sportscaster and does baseball analysis, and we have the same name. But he doesn't use the M. I use the M. This is a distinguishing bit. So if you simply Google Christopher M. Russo, you'll find me in my work. I've got a temporary setup right now, Christopher-Russo.github.io, where you can see my about page, some of the research I've recently been doing, my blogging, and you can sign up for my email list, which is my fledgling email list to send out all the interesting things I think are interesting that I'm working on. Everything from Fed monetary policy to, as Todd mentioned, academic work on the macroeconomic dynamics of pre-industrial England.
Yeah, I recommend it. Thanks for listening. If you like the show, the best thing to do would be to send it to one of your friends who also likes podcasts. If you want more, I have an email list where I send out a weekly update with all the podcasts I've recorded and articles that I've written. I also include my favorite things that I've been reading or listening to as well. You can sign up for that at www.toddneve.com. That's I before E, or you can open up the show notes in your podcast player and click the link in there.